We're going to get started. I'm glad the people that are here. This is by far the lightest crowd we've ever presented to. We usually present 100, 200, 300 people, but 2, 3, or 4 people are fine also.
So we were just in Austin a few days ago, spoke to 400 people, and now we have 4 people. So
this is interesting. But we're glad you guys are here. My name is Lee Resnick. This is my twin brother, Terry Resnick. Today we're going to talk to you about a very, very important topic. More people should be here for this. But we're going to talk about what we think may be the most important education a business owner ever receives. And that's showing you how to make sure that you're able to preserve and protect all your years of hard work, transition your businesses, safeguard the IRS from being too aggressive with taxes and things of that nature. So our topic today is business succession and estate planning, protecting and ensuring the successful continuation of your business while preparing for tax law shift and addressing labor force challenges.
So background of our company, Resnick Succession Group, we're a nationally recognized business succession, estate planning, life insurance advisory, and implementation firm. We've presented educational seminars to over 250 organizations over the years, and we're co-founders of the Elizabethtown College Family Business Center and frequent law school lecturers as well. As business owners, we talk about controlling the controllables. There's so many things that we can't control. We can't control the economy. We can't control if there's a recession. We can't control a pandemic. There's so many things that may impact our businesses that we simply cannot control as business owners. But what we can control is what we're talking about today, and that is being proactive with your planning. If you're proactive with your planning, you'll ultimately protect your business and family utilizing tax law that we have available. And you have to think to yourselves, will this be your reality? Will you work decades to build a successful business only to eventually lose it? Will there at some point be infighting among your family? As you can see, we talk about upbeat topics, losing businesses and family fighting. And then will your family and business legacy, what's it going to be? Is it going to be one that is remembered in a good way? You know, certainly no one wants to work decades to build a business only to eventually lose it. But unfortunately, that does happen too often. And we all know if it's not our own family, we know of families that don't get along anymore. And that's typically happens when there's an exchange of assets, the planning wasn't set up right, communication breakdown. So we want to make sure that doesn't take place. And then finally, you want to make sure that you have a strong business legacy, whether your family stays in the business being the ownership, or just that your business continues to other owners and that you have a strong family legacy as well. A lot of people that don't own businesses, they may see businesses that have been around and they're gone all of a sudden. And in their minds, they think, well, they must have made bad decisions or they just didn't run the business well. But really, a leading cause of business failure is inefficient, ineffective, and non-existent business succession and estate planning. It's really just many times business owners neglecting these areas, and then things just kind of turn out how they turn out, which generally is not good. So when we talk about succession planning, it's much more than having in the back of your mind, when I'm age 65, 70, 75, I'm going to retire, or the kids will figure this out after I die. That's not a proactive succession plan. The succession plan is a deliberate and systematic effort by a company to ensure leadership and ownership continuity. So succession planning, a lot of people feel in their minds that they have this stuff taken care of because they met with their attorney or CPA and they have a plan in place. And that may be true, but the key words in this slide are deliberate and systematic, meaning that you just can't set up a plan and forget about it, because many people have succession plans, estate plans, but they haven't updated them in 15 years. And you can all think to yourselves about your own businesses. 15 years ago, they were probably a lot different than they are today. So sometimes succession planning is set up, and it's set up perfectly, but because so many things change over the years, tax law change, industry, family, all these things surrounding the business, it has a direct impact on the planning that may have been great the day it was set up. Other business owners have succession plans, and unfortunately, they weren't good from day one. But how do you as business owners really know that? Because you're counting on your advisors to put this together and thinking they're doing it right. But you have to be 100% certain that it's set up properly. When we look at all the businesses in our country,
a lot of people think it's large publicly traded companies that really drive our economy, but in reality, it's the people in the room. It's privately family-owned businesses are 90% approximately of all businesses in our country. So that also comes with the real responsibility to make sure that the succession plan does work well, specifically if you want your business to transition to the next generation in your family, key people, whatever that may be. But unfortunately, there's a long-standing fact, and that is 2 out of 3 family businesses will fail to make it from the founder to the second generation, and only about 15% will make it from a second to a third, and each generation, unfortunately, gets worse and worse. And what's concerning and troubling about this statistic is more business owners can recite the statistic of this 2 out of 3, but what we have not seen is any improvement on it, which means they're not being proactive with their planning, they're not updating. So a lot of these things we're going to repeat during the course of our conversation because we want those to serve as takeaways for everyone. So a common trait among our most successful clients, it's excellent communication. If you have a family business and it's a multi-generation or you know it's going to be transitioned down, you must communicate together. And we know for some business owners that may be a challenge, especially older ones, which no one in this room is that old, but when you see people that maybe are in their 70s, a lot of them have a really strong emotional attachment to their business, and it may be difficult to talk to the next generation. But you have to think about this. The businesses that you have today, if you want them to ultimately transition, they're going to go in one of 3 ways. As is in the current condition, which is rare, weakened, or strengthened. We know statistically too often the business is sent down to the next generation in a weakened state or a state of chaos. And as Terry mentioned earlier, we talk about legacy. Do you really want that to be your legacy, or do you want it to be a strong business going forward and setting them up in the best position? So if communication is a challenge for your family, it must become a primary focus if the goal is to ultimately transition the business to the next generation. If you're in a situation and you really have a lot of dysfunction within your family, which some clients we work with, there's a lot of things going on. There's family business counselors out there that all they do is work with the psychological steps within family business structures, dynamics, things like that. And if anyone needs help in connecting with one, we work with those people as well.
And when we talk about business succession planning, it really does start with this checklist, and you can think to yourselves, have these items been addressed? The very first item before you get to an end result, you have to first define what is your personal goal and vision for your company. What is the future going to be? Who is a successor or successors going to be? You have to know that before you can really start doing the planning. Item number 2, techniques to reduce or eliminate estate taxes. Estate taxes are taxes that are imposed after someone passes away and assets are transferred to anyone other than a qualified charity or surviving spouse, both business and non-business assets. We're going to touch upon the Tax Cuts and Jobs Act of 2017. 2017 seems like a long time ago, but it is a current tax act as we sit here today. Item number 3, sufficient liquidity to avoid the forced sale of your company and also for estate equalization. We're going to talk about liquidity in a while. Liquidity is so important. You know, you all have successful businesses, they all drive cash flow, but what happens when there's a liquidity event down the road, whether it's for estate taxes or for buyout, if the liquidity position is not where it needs to be, it can throw off the entire plan. Even if you have the best attorney in the world, the best accountant in the world, if the liquidity position is not there, there will be problems. Another area is estate equalization, and that is specifically when a family business, you have parents working in the business, one or both, and you have more than one child and they're not all involved in the business. So as an example, say someone has 3 children, only one is actively involved in the business. And for most business owners, the business-related value is typically about 70% of their net worth on average. So what happens if a business owner has one child that they want to get the business, but they want to treat all 3 kids equally? Does it make sense to leave all the assets, including that business, equally when for the business assets and the business as a going concern, you're going to have 2 people that together control this company and one that runs the company or will run it in the future has minority ownership? So that often doesn't make sense. So there's estate equalization techniques out there that can help provide liquidity to the non-active children so they don't get business interest, and make sure that those running the business do. Item number 4, business interest transfer techniques to help achieve succession goals. If your goal is to transfer your business in whole or in part during your lifetime, especially if it's to the next generation, there's different planning techniques that can make that happen and also reduce taxation, sometimes significantly. And item number 5 is having an independent review of your legal documents and life insurance contracts to confirm that they actually meet your goals and objectives. Too many people, and it's not just your industry, you can pick any industry, you have very successful business owners that are sitting on financial ticking time bombs, whether it's their legal work, accounting work, insurance work, and because so many business owners understandably are focused on their running their companies, which of course has to be the first priority for a business owner. But with that being said, there's surrounding planning that's protecting all that hard work, protecting the company. Many business owners are not in the position they think they are.
Another message we always impart during these sessions, and you'll hear this a couple of times, is much more important to know that you simply have something in place, that you must know specifically what you have, meaning that there's different types of trust, buy-sell agreements that we're going to talk about. Insurance contracts vary. So we hear all the time people will come up to us and they'll say, yeah, we have a plan in place, our attorney did this, we have a buy-sell agreement. We asked, do you know what type it is? No, but we definitely have it. As we'll talk about later today, the end result of planning can be vastly different. The success of the plan can be different. So it's really important to take away the message that you must know specifically what you have, not just that you have. What, Terry? What's that?
An often missed business succession component, which a lot of people don't think about because they're focused on the ABCs of this, is the retention of key executives and key employees. Too many people are not retaining their key people in their businesses. And what happens is, if you can think to yourselves, if you go back after this conference and you have some key people that aren't there anymore, they left for whatever reason, how much of an impact will that have on the success and profitability of your company? If you say to yourselves, that would have a major impact or some type of impact, we have to figure out ways to retain those people. So there are certain deferred compensation programs out there that will essentially tell the employee that if they stay with you until retirement, you provide a very nice benefit at the end of the day. And for example, many of our clients are set up where they'll take care of their key people, that when they hit retirement, their ending salary, whatever that was, will be paid out to them their first 10 years into retirement every year for 10 years. So you need an incentive to keep them there. We don't have time to get all into the nuts and bolts of it, but employee retention is huge, and too many business owners are not nailing that aspect of the plan.
And with these programs, really quickly, you can layer benefits. So you can have a very strong retirement distribution for the key executive or key employees. And also, should something happen to one of these people that you're wanting to retain prior to retirement, you can take care of their family. So also, should the employee leave prior to retirement for any reason, which is rare because they generally will serve as a golden handcuff, but if they would leave, the asset remains with the company. So you started this program, it's not as though you've lost anything, and then that plan can be transferred to a current or new employee. So it's very flexible.
We're going to transition to the Tax Cuts and Jobs Act of 2017. There's a lot in this tax act. The only thing we're going to touch upon is the estate and gift tax. So the good news with this tax act is in 2024, individually, we can each shelter over $13.6 million of assets. Married couple, over $27 million combined. That means in 2024, hypothetically, a married couple passes away, they have a combined estate, including their business, all their assets of less than $27 million, they could completely avoid paying federal estate taxes. It's by far the highest exemption amount in our history. It used to only be $600,000 per person for many years, then $1 million, and it got ratcheted up. The 2024 annual gift tax exemption, $18,000 per individual, that you can give away on top of that to get money out and assets out of your estate. Anything over the exemption amount, the tax rate is a flat 40% for every dollar. And permanent. A lot of people think this is a permanent tax act, a tax cut, but major change is coming. We talked about being proactive a few times already. The opposite of being proactive is being complacent, and complacency will cause the loss of assets and higher taxes to be paid. Specifically with this tax act, this high exemption amount we just mentioned is going to be cut roughly in half on January 1st, 2026. It's probably going to fall between $5 and $6 million per person. So the example I just gave, say you have a married couple, $22 million combined estate, they die in 2024, they owe zero in federal estate taxes. That same $22 million estate, they die in January 1, 2026 and beyond, they're going to owe millions and millions of dollars in estate taxes just because of a shift in the tax law. And this is something that's definitely going to happen unless an act of Congress changes it prior. So the reality, though, is even if you're thinking to yourselves, well, I think even once the exemption gets cut in half, we should still be okay. We're not going to be hit with estate taxes. Even if you're in that position and that the estate tax isn't a concern, the reality is that business survival is not guaranteed. Even if you're under that exemption amount, there's so many other challenges out there for you as business owners that you have to contend with.
This is a conceptual slide. Most business owners, they spend tens of thousands of hours building their business, growing their assets, but you really only need maybe 10, 15 hours or so to put a solid succession and estate plan in place. And then once you have a plan, you want to update it periodically or annually. And you also want to make any changes when there's a material change to family, business, or tax law. Terry referenced that earlier, that people could have a plan in place, 10, 15 years go by and it's different. If you have a plan in place, it could be really good, but if the surrounding issue change and the plan becomes antiquated.
Some of the most common mistakes we see: complacency, frustration. People put this off because they don't have to do it today. They'll get to it next week, next year, and sometimes it never happens. Sometimes people become frustrated because they don't understand a lot of the legalities, the terminologies. You don't need to be an expert on the technical jargon. You just need to know what you want to accomplish and work with people to get you there. Certainly if you pick up education along the way, that's great. Unrecognized estate size and tax hit. Specifically, that goes to what's the value of your business. Most business owners don't know the fair market value of their business. However, the IRS insists upon fair market value. And we're going to talk about valuation in a little while and how to deal with that. Poor liquidity position, we mentioned that a little bit earlier. Absolutely critical to have the liquidity in place when the liquidity event hits. Improperly arranged life insurance. Life insurance sounds like a basic asset. It's probably the most confusing asset for business owners, and many business owners are structured improperly where that's concerned. And then finally, lack of specialized planning. Very important to have specialists in each area of their professional life, knowing what they're doing and getting you where you need to go. Just ask him, can you advance it, please? Just tell him. Okay. When we talk about the quote-unquote simplicity of business succession and estate planning, a lot of people do get overwhelmed with it, but it really breaks down as basic as this slide. Everyone in this room that's a business owner, you have both business and non-business assets. At some point, you're going to want those assets to go to whom you want, when you want, and how you want. But are you 100% certain that the plan that you have today is going to make that happen? Statistically, most business owners, the answer is no. And many have no idea that that's the case.
So we touched upon liquidity needs and the importance of liquidity. We're going to go over liquidity needs for estate planning and succession planning. With estate planning, there's administration expenses. There are certain states in our country that still have their own estate tax in addition to the federal estate tax. And those taxes are due within 9 months after the date of death. That's not a lot of time to raise capital if you don't have the funds. If you're married, you can defer the estate tax to the second death. So spouses can transfer an unlimited amount of assets during life and or death. There's no tax, but upon the second passing, that's where the estate tax is going to come into play. And also family income needs generally remain. And when we look at succession planning, if you're in business with more than one person, buy out a business interest, capital to strengthen the business at transition. We talked about if you're proactive and a business is being passed down, you can actually strengthen the business as opposed to providing a weakened or chaotic business for the next generation. Also, if you lose key executives, there's liquidity needed to get new ones. And if you do retain the key people, the deferred compensation arrangements need to be paid out. But when those are done properly, the funds will be there.
When we look at sources of liquidity, almost all business owners fall into the bottom category, the illiquid category, because their wealth is tied up in their businesses, real estate, hard assets. And even though when a liquidity event hits, being primarily illiquid isn't a good thing, we're of course huge proponents on business ownership, real estate. Those are the two primary ways to create wealth. However, you have to have surrounding planning in addition to the assets that you have during lifetime. So let's look at the ways to meet a liquidity event. One is cash. Let's say it's for an estate tax and you happen to have enough cash in the estate. That's certainly an option, but is it the best option? Of course, if you pay out your own cash to the IRS, you're going to reduce the total bequest to your family because they're not keeping it, the IRS is getting it. You're reducing funds that the family might need for current and possibly future expenses. All the future earnings on those funds are gone. You gave them to the IRS. All the opportunities, acquisitions, all the things you could have done with that money, gone. And capital to run the company is gone. So let's say the business transitions per the succession plan and it gets to that next generation, but a whole bunch of cash needed to be used to satisfy an IRS tax liability, estate taxes. Well, that capital that could have stayed with the company is now gone. So we've got to do everything we can to protect it. Another method to pay or meet a liquidity event is a sale of illiquid assets. That's really kind of the worst way to meet a liquidity event, because what you're going to do is, of course, reduce total bequest to the family, just like with cash, because you're selling an asset just to create cash to pay off a liability or some type of obligation. You lost all future income. It could have been a fantastic piece of income-producing real estate. It could be your business. All the income that that asset has derived is now going to be gone. And what's even worse is more than likely you're not going to get a fair value because you're doing this in a fire sale situation. As Lee said, taxes due within 9 months of the date of death. If we're in a down economy, down real estate market, whatever it might be, and you're forced to sell assets at a down time, you're not even going to get a fair value. So it's just not a good situation. Another payment method is life insurance. If life insurance is done properly, and I use the word if a lot when it comes to life insurance, but if done properly, it's by far the least expensive method to pay estate taxes and other costs. The death benefit may be estate tax-free if policy ownership is set up correctly and income tax-free as well. The life insurance preserves assets, including the business. Now, a lot of people have heard that, oh, I thought, once my house is paid for and the kids are grown, we don't need life insurance, because there's people that actually say that. If you're a business owner, you absolutely need life insurance. Maybe non-business owners don't, but if you're a business owner, life insurance is one of the very best assets to have. And you have to think to yourselves, regardless of what some people might say, there's a reason why people that are worth hundreds of millions of dollars and billions of dollars have tons of life insurance. Because why would those people need life insurance? They have all these other assets. Did a slick salesman come by and say, yeah, I'm going to sell you a $200 million policy and pull the wool over their eyes? No, that didn't happen. Hugely successful, ultra-wealthy people acquire a lot of life insurance because they understand the substantial tax advantages, as well as the leverage from premium to death benefits. So if done correctly, it's a fantastic asset. It preserves the assets, including the business, because you're just creating blocks of discounted tax-free liquidity to meet the obligation, keeping all the other assets, including the business, with the family. And it maintains family harmony. The family's never put in a position of figuring out, how do we pay this obligation? We don't have the cash, because the insurance does that.
We talked about everything being tax-free with life insurance, income tax-free, estate tax-free. But for income for estate tax-free, you have 3 options you can do to make sure that definitely occurs. As far as the ownership of the contract specifically, you can have an irrevocable trust own the contract, an LLC, or adult children. Any form of ownership in these 3 ways will keep everything income and estate tax-free. There will be no erosion.
And life insurance mistakes will needlessly result in a tremendous loss of capital. Life insurance is one of the last remaining assets that should be tax-free across the board, but many times, as we just mentioned, it becomes taxable, income and or estate taxes. And people say, we pay taxes, what's the worst tax I pay? Is it income tax or capital gains tax, sales tax? It's none of those taxes. The very worst tax anyone ever pays is a tax that they legally could have avoided paying, but they ended up paying it just because their planning was messed up. And that happens way too often. You look at an insurance contract, it's $1 million contract, should have been a net $1 million. You're going to pay hundreds of thousands of dollars in taxes if it's set up wrong. $10 million policy, you're going to pay millions of dollars in taxes for no reason other than it was set up wrong. And that happens more often than you'd realize.
And life insurance should be viewed as an asset because it's an asset. It's not a liability. If you're putting money towards anything and you receive more back, that's an asset. It's not an expense. But commonly, it's the second largest asset for business owners behind the value of their business and business-related assets. But there's a major problem. Most business owners do not understand the second largest asset they have. They just don't put in the homework and due diligence that they would for any other asset with that value. So if you had $5 million of insurance or $10 million, people just arbitrarily okay, well, this option's lower than this option, I'll do that, and that's the end of their analysis. If they're acquiring a business or property or equipment for $5 or $10 million, they're doing a lot of homework on it. And if you don't do the homework, it's going to lead to problems with your business succession and estate planning.
And we asked this in Austin a few days ago. We had 400 plus people in the room. They didn't raise their hand, and no one's ever raised their hand for the thousands and thousands of business owners we've spoken to over the years. You can think yourselves, has anyone in this room read their life insurance policies word for word, cover to cover? No one ever does. No one's ever raised their hand. First of all, it's boring. Secondly, the way it's written can be confusing, but it's so important because you're buying that contract, not an illustration that your salesperson might have given. You're buying that contract. It's legally binding. It is critical to understand the language in those contracts. And what type did you or will you acquire? There's all these different policy types out there. We're not going to go into each one, but just to let you know, they're very different. They're not all the same. And specifically, we say concern and caution for the following policies: universal, variable, and variable universal are all concerning types of policies because even though they're marketed as permanent policies, the following items are not guaranteed. Premium's not guaranteed, cash value, and even the death benefit. None of it's guaranteed. We often have people come up to us and they'll say, well, we get an annual statement every year and it shows we have cash and we have a death benefit and our premium's never gone up. Internally, the premium has gone up every year. The reason you're not seeing an out-of-pocket increase yet is there's enough value in those contracts to offset the increase in costs. But at some point in the future, as the insured gets older, the internal costs cannot keep pace with the increasing expenses and the policies start to implode and often do with no value.
And this is an area that is difficult for business owners to really wrap their heads around because they're saying, well, if I'm paying a premium every month or every year, I can lose my insurance. Absolutely. If you Google class action lawsuits and put in one of these policy types, there's a lot to read. And another message with this, contract supersedes company. Some people have the false sense of security because they have ABC company that's been around for 150 years, it's highly rated, all these great things, they're fine. That's not the case. The contract will dictate what happens to the policy that you have.
So yes, the company's safety is very important, but the contract is what's critical. When we talk about insurance company safety policy selection, you can think to yourselves, was your life insurance acquisition based upon strict due diligence? Did you put in the same type of thought and effort into that asset value as you would any other asset value at that same amount? Typically, the answer is no. Do you know the Comdex score of your insurance company? Have you ever heard of it? Most people have never heard of a Comdex score. That goes directly to the financial safety of your company. There's independent financial rating service, Standard & Poor's, Moody's, AM Best, et cetera. They all give letter grades to determine the financial stability of an insurance company or any other financial institution. The Comdex score takes those letter grades, which are not uniform in scoring, and turns it into a numeric score, with a 100 being the best. Everyone in this room should know the Comdex score of your insurance companies, and if they're not in the 90s, you have to ask yourselves, why was that company sold to me? There's over 2,000 companies out there, and there are some very well-known companies that don't have the greatest Comdex scores. Very important to know what it is. And then, are you certain, with all the changes in the marketplace, that you have policies with the lowest net cost? Net cost does not always mean premium. And we hear this quote all the time: I thought life insurance was tax-free. Many people think it is, but there are income and estate tax situations, as we mentioned, that make it taxable. The key is the ownership of the policy. That must be set up correctly. It's not who receives the money, it's actually the ownership of the policy, which will determine if there's going to be any type of tax ramifications. The Pension Protection Act of 2006, this is huge. You can all think to yourselves, if your entity, whether you have a corporation, LLC, partnership, has taken insurance out on any employee, even if it's you as the owner as an employee, after the Pension Protection Act of 06, so in the last 18 years or so, and the insured, including if it was you, did not sign an acknowledgement and consent form before the policy was issued, the entire death benefit will be 100% income taxable. There's no way around it. We've reviewed so many, when we're reviewing all the legal documents, valuations, we get to the insurance contracts review for people. We've seen so many times over the years, there's entity-owned insurance and they don't have these forms, and they're shocked to find out that their tax-free death benefit is going to be taxable. The worst example we saw, we were working with, it's not in your industry, family out on the West Coast. They had over almost $300 million of life insurance for their family, huge businesses all over the country. Not one of the policies had the acknowledgement consent form signed. So you're talking about $300 million of assets roughly that should be 100% income tax free, going to pay tons and tons of taxes just because their people didn't set it up right.
Second step to this PPA of 06, any policies that the entity has, there must be an 8925 form filed every single year by the CPA. But even if that's done without fail and the acknowledgement and consent form was not signed, that doesn't correct the issue. So that has
and then there's even more, which we don't have time to get into, that can cause it to be taxable. So you as business owners have to think to yourselves, when it comes to your life insurance, do you have complete understanding what you really need to have of the type of policy you have, how it actually works, the company's financial safety, what that Comdex score is, the policy design, the policy ownership, and all of the potential tax traps. I know as busy as you all are running companies, it's very hard to also have a complete understanding of this entire list. We're going to transition to valuation. We mentioned that a little while ago, and the importance of fair market value. This definition on the screen is the IRS's definition of fair market value. As you read it, you can see it is somewhat subjective. The good news, going back to the words we've been using earlier, being proactive, controlling the controllables, if you do that, you can take advantage of this. And how you go about doing that is there is a key IRS revenue ruling, Internal Revenue Code ruling, I should say, 5960, that correlates directly to fair market value. And these different factors on this screen are what makes up fair market value. Two areas that you can take advantage of are minority discounts and marketability. So let's say, as an example, you have a business valued at $10 million. You want to give $1 million of it to your son, $1 million to your daughter, 10%. Well, that 10% is a minority interest. There's no control. So the IRS, which is one of the rare things where they're actually on our side, they realize that it being a minority interest, there's no control. That 10% owner cannot make changes, do anything, make any decisions for the company. So the IRS says, it's not really worth, $1 million. And there's no true market for it because no one's going to pay $1 million for a business interest that they have no control over. They'll give a discounted number. So typically, without pushing the envelope, you can take a 30 to 40% combined discount. So in that example of giving $1 million each, a business interest, his son and daughter, Maybe you're shifting $1,300,000, $1,400,000 outside of your estate for the value of $1 million. And let's say hopefully you live decades beyond that. Had you not transferred it, all of the appreciation would have been in your estate to be hit with taxes, but you got all the appreciation out as well. So it's all about that. A lot of people say to us, well, how do you value a business? Can my CPA do it? Your CPA may be able to do it, but we always suggest having an independent valuation specialist do it. Our firm, we do not do valuations. We're never going to do valuations, but we're huge proponents because if done properly, you can save at a minimum probably hundreds of thousands, if not millions of dollars in taxes if having a proper valuation.
And for family businesses in our country, it's almost a certainty that when the 706 return, the estate tax return, gets filed, it will be audited because the IRS knows that a family business being transitioned down to the next generation, a lot of times that's going to be at a lower value than it would to an outside buyer. So the valuation is really, really important. We don't have time to get into this section because we're limited on time, but this is a quick area. And also, if anyone wants the PowerPoint, we can make sure we can get this to you. And also, there's yellow sheets on everyone's table. If you guys could please sign in, we'd appreciate that so we can keep track of who was here. But if you're in business with someone and you have an installment method buyout, which is simply saying if something happens to owner A, we're going to pay out their family X amount over 10 years. Sounds very easy. It's very simple. It can be wrought with problems. It can be very expensive, and it can hurt both parties. And we just don't have time to go into this section.
As Lee said, we will email the presentation to anyone that wants it. Just transferring or transitioning to properly structured, properly funded buy-sell agreements. Buy-sell agreements are documents that your attorney will put together. Basically spells out what happens to a business owner's interest when he or she departs a business. And there's three key components, or should be three key components in a real good buy-sell agreement. One is language within that agreement that addresses all contingencies, also known as triggering events. If a business owner retires, becomes disabled, dies, withdraws for any reason, it's in that agreement. Secondly, what's the value of the business interest? How is that determined? That's got to be in there solidly. And then finally, funding. Where's the money coming to buy someone out? When you look at the choices to fund a buyout or buy-sell agreement, there's really only three choices. The purchaser can borrow the money. You could, as Lee mentioned, that installment method, pay out over a period of time, but there's a lot of problems with that. And life insurance. The advantages of a formal buy-sell agreement is a surviving owner maintains continuity of ownership and management. If Lee and I are in business together and we have no buy-sell agreement and he dies, what happens to his business interest? Do I buy it back? Does a company buy it back? Neither. Basically, that business interest stays with his family, and his family is now in business with me. I have 70%, and they're completely dependent on me to keep this thing successful so they can get some type of payout along the way. Conversely, if I die first and he has 30%, my family's holding 70%, they could say, we don't want him to run it. We're just going to sell the business. We have control. Without a buy-sell agreement, it puts everyone at risk. So it's very, very important to have one. The decedent's estate converts unmarketable, non-liquid business interest to cash, especially if it's a minority interest, because you're guaranteeing a buyer and guaranteeing a purchase. It provides a fair and reasonable price. Now, there's two types of buy-sell agreements. We mentioned earlier how it's very important to know more than you have something in place. For example, if you have a buy-sell agreement, that's great. But then the first question is, what type do you have? And we're going to show you two examples of the two types of agreements and how the end result can be very, very different. So there's something known as an entity redemption or a stock redemption with the corporation and a cross purchase. So we're going to go through two basic examples. We have Al and Bob. They form a company together. They each put $500,000 in to get it started. 10 years later, it's worth $10 million. They decide, we should really get into a buy-sell agreement. You should go into a buy-sell agreement the day you get into business with someone, but they waited like a lot of business owners do. And they decided to go into an entity or stock redemption plan. So Al and Bob, they both get insured. The corporation becomes the owner and beneficiary of a $5 million policy on each. Al dies. The $5 million death benefit that was on his life is payable to the company. Per the buy-sell agreement, the company pays Al's estate $5 million. That's a net number. There's no taxes because there's a step up in basis when we pass away in our country. So the family gets $5 million. The family redeems the stock back to the corporation. Bob is sitting here. He has all the stock, same number of shares he started with. They're worth twice the value. Our shares were retired as treasury stock. If Bob decides to retire and sell the company for $10 million, he's got to pay capital gains taxes on $9.5 million. The $10 million sales price minus his $500,000 of original basis. So we're talking about a huge capital gains tax hit. Conversely, if they would have set up a cross-purchase plan, same scenario, they both started business together by putting $500,000 in. 10 years later, it's worth $10 million. This time they enter into a cross-purchase. The key difference here is there's no corporate involvement. It's an agreement between the two business owners. So in this case, for the funding, Al is going to become the owner and beneficiary of a $5 million insurance policy on Bob. Bob's going to become the owner and beneficiary of a $5 million policy on Al. Same scenario as before, Al dies. This time, Bob is personally paid the $5 million on the policy he had on Al's life. Per the buy-sell agreement, Bob turns around, pays Al's estate $5 million. Al's estate, same net result, whether it's a redemption or the cross-purchase, they're getting $5 million net. The estate is selling the shares back to Bob this time, not the corporation, but to Bob. If he sells the company stock for $10 million like he did previously, since he bought Al shares for $5 million and he had $500,000 of original basis, he's only paying capital gains taxes on $4.5 million. The entire $5 million purchase price of Al shares, a purchase without zero capital gains taxes. In the redemption, the entire $5 million got hit with capital gains taxes. I mean, that's a huge difference and why it's so important to know specifically what type of agreement you have. Also, there's plans out there, if you're a C corporation or an S corporation that was a previous C corporation that brought retained earnings over, there's something known as attribution. Even a lot of CPAs don't know about it, but it falls under Section 302 and Section 318 of the Internal Revenue Code. And essentially, without getting into too much detail, instead of these tax-free swaps, lots of taxable events, forced distribution, dividend. It's a real mess. So,
And on the table, if anyone has a buy-sell agreement, there's a buy-sell agreement checklist on some of the tables. It's a good exercise to go through. Also, there's a questionnaire along with the yellow sign-in sheet. But when we look at
complete. So anyways, when we look at this, there's a successful transition for Al's family and Bob, right? When we're talking about the cross-purchase, but was it really? The buy-sell agreement was never updated. So what changed in their situation? Plenty changed in their situation. Al and Bob each had a son come into the business, Al Jr. and Bob Jr. Al, of course, at some point wanted his interests go to Al Jr. Bob, of course, wants his interests go to Bob Jr. So let's talk about Al's son's ownership future. It's not a very long discussion because both the redemption and the cross-purchase, Al disinherited his own child. It's that simple to disinherit your own child. So what should have been done, even though the cross-purchase made sense in the example we went through, we've talked today about being proactive, periodic reviews. At some point, things changed. And once Al Jr. and Bob Jr. came in this business and showed that they were going to continue running it, we wouldn't want a buy-sell of being a stock redemption or a cross-purchase. We would want one-way lineal descent from Al to Al Jr., Bob to Bob Jr., and whether they're going to buy it from their father, be gifted from their father, however it was going to be done, it's going to stay lineal descent so the shares don't get bought out.
And when the business gets passed down to the next generation in that example, then Al Jr. and Bob Jr., they should have like cross-purchase. That way, the stock is completely insulated. It can't leak out to anyone that shouldn't have the stock or that's not active with the company.
So if the business is not being passed down to the next generation, as an example, or sold to an outsider, sometimes an ESOP comes into play. We don't have time to get into all the details on ESOPs, but ESOPs in certain situations can be a very viable strategy, very beneficial for the business owner, very beneficial for the employees and the business as a whole. But it's also important to know there are different types of ESOPs out there. So again, a lot of people have an understanding there's just one type of ESOP, and there's not. So it's really important to know if you're considering ESOP, that you know exactly how they work. And we're going to wrap up with a case study, just a fictitious family business and a name of a family, their estate and succession plan. The case facts, we have Louis and Louise Young, 75, 73 years old. They started ABC Inc. They're both extremely active in the business. And they want to make sure that if they can, they want to work until the day they pass. This is their livelihood. They love to go into the business and they want to be involved. And they have 3 children, Joe, Mo, and Helena. Joe and Mo are extremely active in the business. The goal is definitely that they'll continue running it into the future. Helena is not involved in the business. She has another career. Joe is not married. Mo is married to Nora. Helena is married to Ken. Neither Nora nor Ken are active in the business. Louis, Louise, Joe, and Mo each own 25% of the company. Fair market value, about $7 million. Total estate value for Louis and Louise, about $10 million. The current plan was that Louis and Louise had basic wills. Louis dies first, everything goes to Louise. Louise dies second, everything equally to the 3 kids, and vice versa if Louise passes first. There's no buy-sell agreement. The children, Mo and Helena, have simple wills with their spouses, and Joe's single. He figured he didn't need any estate planning. The goals, however, were a bit different than the way the plan was set up. The goals were to distribute the estate fairly, not necessarily equally, but fairly upon the last die of Louis and Louise. They wanted to ensure that the company that's essentially being run by Joe and Mo right now continues to be run by Joe and Mo, and that their daughter Helena receives non-business assets since she's not involved in the business at all. So the results of the current plan after death of both Louis and Louise is everything flowed equally to the 3 kids. And on the surface, it doesn't seem too bad. I mean, they all got the same cash distribution. Joe and Mo together control the company, and Helena has 16%. But what often happens is friction starts to develop. And in this case, Helena's husband, Ken, is telling Helena, you know, we own this business. We're not seeing anything for it. Go tell your brothers you want to be paid an income. She didn't understand that even though she's an owner, she's not an employee and can't be paid an income. And their brothers explained that, and she was fine with it. She told Ken, and Ken said, well, I've been reading business books, and I know there's something, distributions, dividends, or some term out there that we could still get paid, so go tell your brothers that's what you want. So she goes back to her brothers. They start to tell her, Helena, you know, we're not going to do that. We have a lot of investment we have to make in the company, and you need to kind of leave us alone and let us run this company. If we ever sell it, you'll get your 16%. We're not looking to sell it, but if we do, then you'll get taken care of then. It puts a family in a situation where they're starting to not get along so well, and they were always a close family. Another problem that happens, Mo, let's say, God forbid, something happens to him, there's no buy-sell agreement. That business interest that he owns goes to Nora. And there's one slight problem with Nora. She was the in-law that no one liked. They didn't like her when they first met her. They didn't like her after she married Mo, et cetera, et cetera. She now has 42% of the company. And there's one person that starts to like her real well. That's Helena. Go on.
So with that, Nora and Helena, they control the company. They have over 50% combined. Joe, the president, the one that runs the company, he's literally lost control, figuratively, literally. The employees don't know what's going on, so you could have had a really strong company culture. That starts to erode. All these things occurred simply because there's not a buy-sell agreement. So what should have been done to avoid those issues is Louis and Louise, again, they were going to stay until the day they were gone. But once they were gone, they wanted their sons to buy the business so they would have more liquidity in their estate. So the arrows going down to the boys, that shows the business going to the 2 boys. The arrow going up is the guys buying the business from mom and dad's estate. So how are the guys going to buy the business for $3.5 million, which was a value at the time? And the final arrows is a buy-sell agreement, cross-purchase with Joe and Mo. They put an insurance policy on mom and dad so they would not have to fully fund the buyout. They wouldn't have to come up with $3.5 million or take it from the business or borrow it. So after the sons, Joe and Mo, buy the shares, the parents' estate all of a sudden has $3.5 million of newly created liquid assets. We talked about the importance of liquidity. The parents now have the ability to increase the distribution to Helena because, again, they did not want her involved with the business, since she was not
So
active.
with the $3.5 million, what's important to understand is, and this is where wealthy and generationally wealthy families keep their wealth, is a newly created liquid assets. If it wasn't for the life insurance of $3.5 million, that wasn't there before, but it created $3.5 million of tax-free dollars, got put in the mix, that without life insurance, they would have been borrowing or taking money from the company to pay out. So this is why, again, ultra-wealthy people, very successful people obtain life insurance for these reasons. So basically, we have Louis and Louise passing away, the shares going down to Joe and Mo, cash going up into the estate, cross-purchase, buy-sell between Joe and Mo. And the end result this time is very different. Helena got way more cash. Joe and Mo even got more cash because there was more cash to work with. Joe and Mo together have the company 100%. Helena has 0% of the company, but everyone still gets along and the family stays close and the business stays strong. So in summarization of key points to think about, you must know more than you have something in place. You have to know exactly what you have. Being proactive, periodic reviews of your planning, extremely important, and adjustments for material changes as there's tax law change, family change, business change, have to update that planning to keep it current. And in importance of independent objective reviews of your existing planning, you have to assess what you have. As I said earlier, too many business owners are sitting with a false sense of security on a ticking time bomb that could blow up. And by doing an assessment of your planning now, one of two things is going to happen. One, it's going to either confirm exactly what you have is where you need to be and you just do reviews periodically, or two, you're going to discover any problems now, not when it's too late or after someone passes away. So very important. As far as a follow-up, there's questionnaires in front of everyone. Feel free to fill those out. If you want to go over some more information, as Lee mentioned, there's that buy-sell agreement checklist. It's a good practice to kind of go through it to see where you are. And we're also going to be around today and also when we get back to our offices, 30-minute complimentary meetings, whether here or on Zoom. So those are all very important to have. And then finally, our contact information. I know we always offer a few minutes of Q&A. I know most of the time no one asks questions because they don't want to ask about their business or family in front of other people. But if anyone does have questions, feel free to raise their hands.
Yes, ma'am.
Yeah, her question was, since we don't value businesses, do we recommend another firm? That's a great question. Yes, we know valuation specialists all over the country. And to add to your question, which we would be happy to refer to anyone, but also just as an FYI, for someone to know, how do I know if someone is really a valuation specialist? What's their designation? Typically, they'll have one of two designations, either a CVA, which means they're a certified valuation analyst, or an ASA, which means they're certified by the American Society of Appraisers. The ASA is a more stringent designation, but the CVA is still very good. And with that being said, just so we clarify, people that value businesses as a going concern typically don't value the real estate and vice versa. So for real estate, the hard assets, that would be someone else. That would be just a real estate appraiser that would come in and do that. Any other questions? Okay, well, we're going to keep everyone on time. Again, if you haven't signed in, please sign in. If you want to complete the questionnaires, feel free to do so. And thank you for your time.
Thank you.